What's up guys, Adrian here. Welcome to my channel on passive income investing. In this video, I want to discuss ETFs that use a covered call strategy. So I really love these ETFs because they provide passive income dividend investors like myself with higher dividend yields without sacrificing safety. So in order to understand how these ETFs work, we need to understand what a covered call is. So a covered call or the covered call strategy uses options trading. So trading options is simply another way investors can make money using stocks. So now it's definition time. So a call option is an agreement between two parties that give the option buyer the right, but not the obligation, to buy a stock at the agreed upon price within a specified time frame. So the buyer of the option pays a fee or a premium to the seller for that right. So the seller keeps the fee regardless of what happens later. So if you're confused right now, don't worry about it. I'll explain using an analogy that pretty much works really well to explain what this is. So let's say you want to buy a house that's for sale. So you and the seller agree on a price, right? But let's say you're a little unsure and you want to shop around some more. Seller of the house is in no rush to sell the house. They're more than happy to live in the house right now. So a small delay works out for both parties. So the potential buyer can buy an option from the owner of the house in order to reserve the house for 30 days with the sale price you both agree on. So the seller of the house will get a small premium, which is a small fee from the potential buyer in exchange for peace of mind, since it gives the buyer the option but not the obligation to buy the house in 30 days. So let's say the value of the house stays the same or goes down within 30 days. If the buyer is no longer interested in purchasing the house, he can walk away scot-free in this scenario, but the seller of the house gets to keep that fee or that premium from the now uninterested buyer. So let's say the value of the house goes up a tiny bit within the 30 days. Well, the buyer will most probably decide to buy the house because the house is worth a little bit more than the actual sale price that you guys agreed on 30 days ago. So if that happens, the buyer will purchase the house from the seller with the price they agreed on 30 days ago, and the seller gets also to keep that little extra premium. Okay, so how does this example or this analogy translate to the stock market? Well, the homeowner in question is the ETF owner, which is us, the investor. The house represents a stock within the ETF. The 30-day reservation sold to the potential buyer is the call option. The agreed upon price is the strike price, and the small fee the potential buyer pays us, the homeowner, is the option premium. So what essentially happens is that the owner of the stock is selling call options to potential buyers of the stock. If they don't end up buying the stock, the owner of the stock gets to keep the fee or the premium, which is basically like free money. So this is really what boosts your income. If the potential buyer decides to buy the stock, let's say because the stock price is a little higher than the agreed upon price of 30 days ago, the owner has no choice but to honor the deal and sell the stock to the buyer at the price they agreed on, making a small profit in doing so. So normally when a call option is sold, the strike price will be slightly higher than the current stock price. So the reason why it's called a covered call is because as the owner of the stock, you're covered in case the potential buyer decides to exercise the option he bought from you and actually buys the stock from you. So as the seller, you're covered because you already own the stock in question. Still confused? Let's analyze the possible outcomes of this transaction. Three possible outcomes. So outcome number one is the stock price goes down after 30 days. So this is good for us, the seller or the investor, because the option expires worthless and the seller gets to keep the premium. So although you're not too happy the stock price went down, you just softened the blow because at least you made a commission in the form of that option premium. Plus, as a passive income investor, you're glad to just hold on to the stock for the long term anyways, just like that house in the analogy. Outcome number two is that the stock price stays the same after 30 days. So this is also a good scenario for us, the seller, because the option is essentially worthless and the seller keeps the premium. So this is simply because the stock price stays the same, so the buyer won't need to buy the stock from you. He could just buy it himself at the same price on the market. Okay, so outcome number three, the last outcome, let's say the stock price goes up above the strike price after 30 days. So in this case, we are obliged to sell the stock to the buyer at the strike price we agreed on, but we also make a small premium in doing so and a small profit as well when we sell the stock. So this can limit the potential for more upside since the stock can continue to rise. So you can miss out on the gain since you already sold the shares to the buyer. So scenario three, although it's the worst outcome out of the three for us, is actually not so bad when you think about it, because since the stock price went up a little bit, we still make a small profit on it when we sell it to the buyer. And don't forget, we still get to keep that premium. The only downside is, however, is that if the stock goes up significantly after the 30 days are up, we lose out on the upside gain since we no longer own the stock. So that's the key to the covered call strategy, guys. You're sacrificing potential upside from the stock in order to boost your income right away. So let's go over 3 reasons why this strategy works really, really well for passive income investors. So it works well, the strategy works especially well with blue chip stocks because their share price tends to be very stable even when the stock market is doing really well. It's just how these stocks work. So since I'm a passive income dividend investor, safe, stable, and dividend-paying blue chip stocks make up the bulk of my investment or my portfolio. It also works great for passive income investors who are not looking to buy and sell stocks. We just buy and hold stocks. So the same goes for these types of ETFs. Normally, we don't buy an ETF thinking the price will go higher in 2 years or in 6 months and we'll sell it to make money. No, we just buy and hold stocks, collect the income they generate along the way. So this strategy also works well during bad stock market downturns when stock prices go down. Why? Well, if this is the case, there's no way that the buyers of those options will exercise the option, so you get to keep the premium. So they're like free premiums. So this essentially softens the blow when stock prices fall dramatically, like now, because at least you're making some extra cash with those premiums. That is why whenever you look at a description of an ETF that uses the covered call strategy, they always say that the strategy lowers volatility or reduces volatility. Now you understand why. So personally, I would never buy and sell call options on my own, just like I would never buy and sell stocks, because I'm a passive income investor and not a trader. But experienced ETF managers like BMO, Horizons, and Harvest have been managing covered call ETFs for years, so I expect they know what they're doing. Also, don't think that the manager will sell call options on all the stocks in the portfolio. They only do it on a certain percentage, usually about 25%. So each ETF manager has their own proprietary strategy or way they use the covered call strategy. So in the description of the video, I'll put links to the fact sheet for each of those 3 companies, just so if you want to read up yourself further on how those 3 companies each handle the covered call strategy. They're very, very similar. So this is considered one of the safest options trading strategies out there. There's basically zero risk. Like I mentioned earlier, the only downside is that you limit the potential upside during a strong bull market. But as passive income investors, we don't care much on the actual price of stocks because we buy and hold them. The income they generate is much more important to us than the potential upside, in my opinion. So to illustrate just how powerful this strategy is, let's compare a couple of ETFs now. So the only difference is that one of them uses the covered call strategy and the other one does not. They're very, very similar besides that. So let's check it out. Let's compare 2 very similar ETFs. One of them uses the covered call strategy and the other one does not, just so you could see the comparison. So ZDV, the BMO Canadian Dividend ETF, just like the name says, invests in a portfolio of big cap, blue chip, dividend paying stocks. And we'll compare it to the ZWC ETF, which is also from BMO. It's called the BMO Canadian High Dividend Covered Call ETF. So both Both ETFs are very similar because they invest in the same types of companies. If you look at holdings, you'll see that they're basically a big cap blue chip Canadian stocks that everyone knows. And if you compare that to the other ETF, it's pretty much the same thing. The companies are almost identical. But now let's check out the dividend yield for both. So the regular one gives an annual dividend yield of 5.95%, which is actually not pretty good. And the annual management fee for the ETF is only 0.35%. So how does that compare with the one that uses the covered call strategy? Well, that one has an annual dividend yield of 9.32%. So you can see it's a humongous jump, a huge increase in dividend. And the management fee, of course, is going to be higher because there's just more work put into this ETF. It's at 0.65 instead of 0.35. But if you ask me, I would definitely rather pay 0.35 more in management fee and get a much bigger dividend. And you can see here also in the description of this covered call ETF, it says call option writing reduces volatility. So that's what I was mentioning earlier in the video. You'll see a very similar description of these covered call ETFs. You'll always see something like reduces volatility, simply because you're getting extra money, you're getting extra income by with those call option premiums. So if you're still not convinced, let's check out another example. So ZEB is the BMO Equal Weight Banks Index ETF. So this ETF invests in the big 6 Canadian banks. So you can see here the breakdown. You got CIBC, National Bank, Royal, TD, Bank of Montreal, and Bank of Nova Scotia. So if we look at the numbers here, so this ETF gives an annual dividend yield of 5.71 and the management fee is 0.55. How does that compare with the same exact ETF that uses the covered call strategy, which is the ZWB ETF called the BMO Covered Call Canadian Banks? So just to look at the holdings, you could see that this ETF also includes the 6 Canadian banks, and actually 28% of the covered call ETF contains the actual other regular ETF that we just reviewed. So, and the rest are just individual the 6 banks. So the ZEB one, like we said, gives 5.71 with a 0.55 annual management fee. What about the covered call one? It's 7.71, so a nice big increase there, and the management fee is only 0.10 more. It's at 0.65%, and you can see here again that call option writing reduces volatility. So as you can see from comparing a very similar ETFs that basically cover the same thing, the ones that use the covered call strategy give a much bigger dividend. So there you have it, guys. That's how the covered call strategy works. Like I mentioned earlier, covered call ETFs are some of my favorite ETFs as they are specifically designed for income investors who strongly believe in blue chip dividend paying stocks. So it's essentially like having 2 sources of income instead of one. So one, you're getting your dividend income, and 2, you're getting the income from those call options at premiums. So as you saw from comparing those couple of ETFs, there's a big difference when it comes to the amount of income you make every year. Investing in a covered call ETF instead of a regular ETF can boost your dividend yield by 2 to 3% per year without adding more risk. So this is quite significant. So which ETFs use the covered call strategy? How do you find these ETFs? How many of them exist? Which ones should you invest in? Well, they are getting more and more popular, and many ETF managers are now offering them. Luckily for you though, you know me and you're subscribed to this channel. So I'm working right now on a 2-part series on ETFs, which should be out in a few weeks. And in part 2, I'll go over a list of about 25 of my favorite ETFs, many of which use this covered call strategy. It took me about 2 years to find all these ETFs, understand how they work, and what region and sector they each cover. So I did all the heavy lifting for you already and created a nice little spreadsheet. So make sure you check out those videos when they're available. All my ETFs, by the way, that I cover are all listed on the TSX and are perfect for passive income investors. Not only do you get more income than regular ETFs, but they're ETFs, so there's no individual stock picking required because the ETF does that for you like a mutual fund. So make sure you check out those videos, guys, so you can start investing in them yourself. So that's it, guys. I hope you now understand what the covered call strategy is and how it works with ETFs. If you're still confused about something, don't hesitate. Ask me a question in the comment section below. I'll be more than happy to answer any of your questions. So please hit the like button if you learned something from this video. Also, make sure you follow us on Instagram and Facebook. I really appreciate you guys watching. Take care and see you next time.